Hi, this is globalinvestorradio.com, and this is the first in the series concerning Richard W Schabacker's methods and techniques. This was a course he wrote back in 1932 called Technical Analysis and Stock Market Profits, and the second edition was in 1937. This is just going to cover some of the basics of what he wrote about in the first introduction to the course, just to give you an idea of his mindset. And this is an edition that was released a few years back in book format, and it covers the whole course. And I have this book that has the complete course inside. And I've just put here, he had the foresight to see through the bull. He worked on top of Wall Street as a journalist, and it's very rare that you find someone that can see through everything that's happening around him and see the truth of the situation. It's a shame he died so young. This is part of the introduction of the course, titled Stock Price Movements, Major Movements, and I've just written a little bit here on the screencast, but I'll read a couple more paragraphs from the actual course. These are the long-term continuous bull or bear market price trends that extend over a period of years and which are the primary concern of long-term investors for income. Having large capital resources and abounding patience, these trends change their course most infrequently, seeming to follow closely the cycles of business. They are apparently more influenced by fundamental economic laws than by those supply and demand factors with which we are most particularly concerned in this study. Now, just going over that first paragraph, that just sums up really how Li Ka-shing and Warren Buffett have made their fortune over the years. And just move on to the second paragraph in major movements. The Dow Jones Industrial Average chart clearly depicts 13 of these bull and bear market swings from 1897 to date, 6 completed cycles and the start of the 7th, which, at the date of this writing, which has not been completed. Note the characteristic low volume periods from which bull markets habitually have their origin, the ensuing markup and the warnings of extraordinary heavy volume without proportionate price gains that signal the first stages of these rises. See how bear markets generally start down from bull market peaks, with at first a sharp increase of volume and price movement, and then are followed by declining activity until the pressure of offerings has run its course and the foundation is laid for a new bull movement. Note the long base that preceded the tremendous bull market from 1924 to 1929, the severity of the bear market that followed in 1932, and the latest bull swing recovery from the latter lows to current date. How clearly this chart reveals the absolute necessity of being on the right side of the market and the utter foolishness of believing that stocks can be put away and forgotten. I thought that was a great introduction to the course, and he speaks a lot of sense there. This is titled Intermediate Movements. Within each major bull and bear market there are many lesser swings, intermediate speculative movements, that generally occur several times within the period of a year. These afford excellent profit opportunities for the technically informed trader, far greater in the aggregate than are possible for the long-term investor holding commitments throughout major movements. Very much the same characteristics of price and volume action are found in intermediate movements, as are noted in the larger major swings, of which these intermediate movements are but component parts. However, because of the more frequent reversals and shorter duration and extent of intermediate price movements, one to profit repeatedly thereby must employ forecasting methods affording a far finer degree of accuracy than when judging the long major trend, and it is here that through understanding and skillful application of the laws of technical analysis pay the largest returns. And this is titled Minor Movements. All of those component short-term movements that go to make up each intermediate swing are referred to as minor trend or intermediate movements, be they a matter of weeks, days, hours or minutes. However, only the most nimble in temperament and skilled of professionals can consistently profit from such narrow movements. The expenses of commissions and taxes are disappropriate to the limited amount of these minor movement possibilities, and do not warrant the wear and tear on the layman's nerves and the increased element of capital risk. Minor price movements, nevertheless, do lend themselves to technical analysis and give thereby early clue to the direction of price trend from areas of uncertainty, indicate the start of a new intermediate swing, and are most helpful guides to the timing of one's market's operations. Okay, that was just a brief introduction to Richard W. Schabacker's course, and I'll be uploading some more episodes in the next couple of weeks. And again, have a look at the Oak Trader Report. It's released every Sunday before 11 p.m. Hong Kong time, and we cover the methods and techniques of Richard W. Schabacker in the broadcast every Sunday. Okay, over and out, and have yourself a good day. Take care now. Bye-bye.